Hey everyone, and welcome. Today, we're going to tackle a really tough nut to crack in the world of finance. How on earth do you figure out what a company is truly worth when it's in a super dynamic, but also super unpredictable, emerging market? Let's dive in.
And really, it all boils down to this one question, right? Emerging markets offer this incredible, explosive growth potential that you just won't find in older, more stable economies. But, and it's a big but, that incredible promise is all tangled up with things like political instability, wild currency swings, and sudden economic shocks. So, how do you balance that amazing upside with the very real chance that things could go south?
So that leads us right into the heart of our topic today, what we're calling the emerging market puzzle. And we're going to see exactly how investors try to solve it. Here's the fundamental trade-off, the paradox at the heart of it all. On one side, you have the potential for absolutely massive returns as these economies just take off. But on the other side, you've got volatility. These huge, unpredictable swings that can literally wipe out value overnight. They're really two sides of the very same coin.
Okay, so talking about volatility is one thing, but what does it actually look like? It's another thing entirely to see it with your own eyes. So let's take a look at what this really means for someone putting their money on the line.
So check this out. It's a tale of two worlds, really. On the left, you see a portfolio of developed markets. It's a pretty smooth, predictable upward climb. But on the right, that's what individual emerging markets look like. It's a chaotic spaghetti mess of lines, with returns shooting up 500% 1 minute and then just crashing. This is the roller coaster investors have to figure out how to ride.
And that chaos you just saw, that's the heart of the problem. You know, your standard financial models, they love stability. They assume things are going to be predictable. But those models just completely fall apart when you're faced with the kind of uncertainty where everything can change in a flash. That's why analysts needed to come up with some new tools for the job.
So how in the world do you put a number on that kind of risk? Well, analysts basically have two main weapons in their arsenal for grappling with all this uncertainty.
The first one is what's called the scenario approach, and it's pretty smart. Instead of pretending you've got a crystal ball and can predict the one single future, you don't. You act more like a chess master. You map out a few different possible futures, a best case, a worst case, and a business as usual case, and then you assign a probability to each one happening. Okay, let's walk through an example to see how this plays out. On the left, you've got a company in a stable European market. You see those nice predictable cash flows, 100, 103, 106, easy peasy. But on the right, that's our emerging market company. There's a 75% chance things go well, but there's a 25% chance of a distressed scenario, where cash flows get slashed by more than half. Suddenly, when you factor in that risk, your expected cash flow takes a big hit, and the company's value drops to just 86% of its stable European counterpart.
All right, method number 2 is the country risk premium approach. The easiest way to think about this? It's like paying for extra insurance. Because you're operating in a riskier neighborhood, the cost to borrow money or the return your investors demand has to be higher to make it worth their while. You're basically tacking on a risk fee.
And here's the really cool part, the big reveal. We get to the exact same answer, just from a totally different direction. Look at the bottom of the slide. This time, we don't touch the cash flows. Instead, we just add a 0.7% country risk premium to the cost of capital. That higher discount rate makes future money worth less today. And voila, we land at the exact same valuation of 1917. Same result, different math.
So you might be asking, okay, but where does that risk premium number come from? Did they just make it up? No, not at all. There's math behind it. This table kind of shows how it works. For instance, if you figure there's a 50% chance that your investment could lose 40% of its cash flow, you do the math, and that translates to a 1.5% risk premium that you need to add to your calculations.
Okay, so that's the theory. But let's get our hands dirty and see how this all works in practice. We're going to put a company, let's call it Conseco, under the microscope.
So this is Conseco. And just take a look at this chart of its projected return on invested capital. I mean, wow. It starts out okay, and then just falls off a cliff into negative territory before, hopefully, staging a comeback years later. This is exactly the kind of scary forecast that calls for some serious risk analysis.
Okay, so faced with that scary chart, the analysts roll up their sleeves and use the scenario approach. They model out a base case where things are tough but the company pulls through. They give that a 70% chance of happening, which works out to a value of about $42 a share. But then they model a downside scenario where things get really ugly.
They give that a 30% chance, and in that world, the stock's only worth about $8.
So, what happens when you blend those two possible futures? You take that 70% chance of the okay-ish scenario, mix it with the 30% chance of the really bad one, and you land on a final probability-weighted value of $32 per share.
But here's the million-dollar question, or I guess the $32 question. Is that high? Is that low? Well, it's all about who you compare it to. If you put Concert Co up against its peers in the US and Europe, it looks pretty expensive. But if you line it up against its actual competitors in Latin America, suddenly it's right in the middle of the pack. It just goes to show you that risk and value are always relative to the neighborhood you're in.
All right, we've been through a lot of numbers and scenarios. So what's the big takeaway here? What's the lesson? Well, it really all comes down to investing with a clear, sober view of the risks you're taking on. So let's just quickly recap the big ideas. It all starts with that crazy volatility. That's the main challenge. To deal with it, analysts have these specialized tools, like modeling different scenarios or adding a risk premium. But, and this is crucial, even with all these tools, the final valuation isn't just a number spit out by a computer, it's a judgment call, informed by the math.
And that leaves us with one last big question to chew on. We've spent all this time working to turn these complex, messy risks into a single, clean number. But can a number ever really capture the whole story? The politics, the culture, the spirit of a place? That, ultimately, is the question every single emerging market investor has to answer for themselves.